it's very easy to kind of forget that we're not going to be here forever. You know, we're not immortal, unfortunately. Although people are trying to work on it, but
our CEO included.
of course, yeah. I'm pretty sure he is, though. So, but the point I'm trying to make is, you know, although it might feel like a million miles away, you know, there's nothing, not to be quite morbid, and I always use this analogy with my family even, is I could be hit by a bus tomorrow, you know. So making sure that you've planned properly for the worst is always better than hoping for the best and the worst happening.
So really pleased today to be sitting down with Ethan Sherlock, who is one of the senior wealth managers here at the De Vere Group. Now, Ethan, you've been here for 5 years now. Do you want to just tell us about your journey into the industry and what you did before that?
Well, yeah, nice to be with you too, sir. My journey into the industry was a bit haphazard, really. Obviously, once I finished university, I kind of just did what I could for quite some time. I had my first daughter, well, my only daughter, my first child, at 21. So I kind of just got thrown into kind of making ends meet kind of thing.
Yeah.
Obviously, worked really hard, and I actually started an insurance company in the UK. Was really successful doing that, really enjoyed it, really happy, and got to the point where we sold the company. I spent some time not really working, took it easy a little bit, and then got approached to join De Vere here in Dubai.
So you had a kid at quite a young age. Do you think that gave you a good understanding of perhaps some of the struggles that parents go through when it comes to financial planning?
100%, because financial planning is difficult, but it's even more difficult if the finances aren't really there. So, so yeah, it seems difficult in some ways, financial planning, with, you know, in the opposite position, but that gave me a good understanding that, you know, you need to be switched on with your finances, look after them, and care for them as much as you care for your child, because at the end of the day, that's who they care for. Absolutely.
And that sort of transition from running an insurance company into wealth management, how smooth was that?
Pretty smooth, to be fair. The company's got some really good systems and controls in place as far as the recruitment process, the training process. There's some really strong and excellent characters that I've met along my journey, and the culture is one of those that, you know, help is given to those who ask. You know, so yeah, it was a bit of a jump, but the people that I've met and the friends I've made along the way have made it a lot easier.
No, that's an interesting point. And for someone who sold your you sold your own company, right? You know all the benefits of building something and then seeing the rewards of it. Now, in this conversation, obviously, we're going to be talking more in depth about how share ownership works for employees in a company. So just on a very basic level at first, and then we'll delve into a bit more detail. How does employee share schemes, or how do employee share schemes work, and how do employees benefit from them?
Okay, so there's a number of ways in which they can work practically, but the simplest way of looking at it is a company is giving their employees ownership in the company in which they work for. Now, there's a couple of reasons why they might do that. One is to increase employee loyalty, reliability. You know, if you look at it from the perspective of a key employee, like a managing director, you know, all the way down to general manager of an office, for example, you know, it does create a little bit of an ownership perspective from that individual, and also create a bit of brand loyalty as well. You know, if someone's been working for, I don't know, Apple for 10 years, and you know, in that 10 years they can build up a fairly substantial amount of employee stock, or employee stock rewards, or it could be, you know, discounted stock purchase plans, you know, where an employee might offer to their an employer might offer to their staff a discount on each individual share that they buy. But the ways that employees get there is irrelevant realistically. The end goal is the same, is to build up a culture of ownership and care for the company as if it is the employee's company as well.
In the same way that you did that with your own company,
Exactly.
But obviously to a more diluted sense.
We were a little bit off Apple on our market cap, but yeah, the goal was the same, to build something and to be part of it and to be proud of it as well.
So when you were running that insurance company, how many employees did you have in the team at that time?
So, as far as directors, there was me, 2 other directors, and then individual employees. It felt like it went up daily. We did expand pretty quickly because we started obviously around North Wales, where I'm from, Wrexham. We had an office in Chester, and we kind of expanded right the way across the north of the country pretty quickly, and then all the way down to like the Midlands fairly quickly after that as well. And obviously in those individual areas we needed area managers, admin staff. It did expand pretty quickly. I'd say as a head count off the top of my head, 50 to 100 staff.
And did you do any employee share scheme with them, or was there how did the benefit system work with that?
So as a director, I had direct ownership in the company, and then as we brought on key stakeholders from other companies, so we found the easiest way to expand as a company was to, for want of a better word, poach people from others.
I mean, yeah,
it is the word. It's standard practice,
yeah.
And as part of that, we did offer, although smaller, we did offer a stake in the company as part of that.
And is it common? I mean, we often see it with the large cap companies, and we hear about that. But how far does it filter down that companies offer this?
It could be even. I've got a very good friend of mine that's looking at starting a business here in the UAE. And at the moment it's just him and his essentially best friend who have got maybe 50-50 ownership in this company. But that's not to say that they can't bring investors on by, say, selling 2% of that company each. Or even though it's not listed, a good example or an easy one for people to understand is, on Companies House, you could have a 1% owner of a company. A lot of people do that for, if they set up a limited company for holding property in the UK, they would add, sons, daughters, etc. for as directors.
So there's numerous ways in which people can have some kind of vested holding or interest in a company.
Sure.
What are the main benefits that we see from an employee's perspective? Not so much from the business, because that's quite clear. You get the aligned interest of the employee and the company. You want to see the company succeed because ultimately what you own will then increase in value. That's very clear.
Sure.
For the employees, what else is there that could be seen as a potential benefit for them?
For the employee, well, it's not only do you get to see, from an employee's perspective, you are building up a lot of the time. Certainly from people I meet, it's their first kind of foray into the stock market, for example. People find that a little bit exciting. It is a bit rock and roll from one perspective. And then secondly, you are building up a value. You are building up what feels like a tangible asset, and you're building wealth through your employer that is more than just a pension feels like it's going to take forever to retire. A lot of people, even me now, I kind of feel like I'm never going to retire, so my pension kind of feels like a million miles away from me. But you a lot of the time you have an online login, you can go and check your shares, and it just creates this sense of you're really building something while you're working for the company that you work for. And a lot of the time you can build up a sizable amount of wealth. And I've got an example that I can run through with you later, actually, of how that has happened with one of my clients, actually.
Okay, brilliant. I mean, that's the upside of it in terms of you say the example of your Apple employee, they're holding Apple shares, they're doing well. Yeah. And that's a good example of where share ownership has really handsomely rewarded employees. But as we know from financial professionals, that's not always the case. You don't just get with most stocks, it's not just a nice upward trend of the share price. Even if the amount you own is increasing because you're continuously adding or getting your pot added to by the company. But say you work at a company that hasn't performed well on the stock market. let's talk through like the downsides of that, or maybe volatility as well.
Well, look, from our perspective, being financial professionals, we kind of understand that stock prices tend to go up over time. Obviously, that's not true for every single stock, or otherwise we'd all be millionaires. But a lot of the time, we can get tricked into thinking like the stock is going to go up forever. And unfortunately, when you've kind of, as an employee, if you've been gifted stock or you've been buying discounted stock, if we look at this last year or so maybe not the last year actually, if we look at 2022 as an example, people who had these stock purchase plans or employee reward schemes kind of went from where markets were at their very peak, certainly in the tech sector, to their shares dropping in value in 70%. And
so how do people plan for that then? So say you had, let's use the example of Zoom, that was a sort of one of the darlings of the pandemic in terms of stock, the stock markets. So you're doing really well. You've seen your ownership fly up.
Yeah.
Are people who have these ownership schemes, are they tied into that stock? Can they diversify away from it? Because it's conventional wisdom that if your stock has done super well, you'd look to cash in the benefits of that and diversify. Can people do that when they've got these stock holding schemes of companies?
It depends a lot of the time. A lot of the time a company like Zoom would do, like there's one from Morgan Stanley that they provide that stock purchase plan to Zoom, who then provide to their clients, if you see what I mean. So there's like an online platform where you can see your shares. Now, sometimes you can, typically after a vesting period, so you have to keep that employee share. So if your employer gives you a share, you have to keep it for a vesting period before it becomes what's called vested.
I heard one person call them golden handcuffs.
Yeah, exactly. Yeah. So you have to, and the reason for that is one, an employer doesn't want you to get the company shares and sell a ton of them straight away. They don't want to see that kind of sale happening every day, or
because then you lose that vested interest that we spoke about
exactly.
before. It goes out the window. Exactly.
So there's a vesting period essentially where you can't sell that stock, and then also on top of that, it's I can't say specifically for one platform or the other without properly reviewing it, but a lot of the time you might not be able to hold other stocks in there. So although you might be able to sell that stock, you might not then be able to diversify into, say, a balanced multi-asset portfolio or into an ETF even.
Okay, so if you don't have that flexibility within the current platform that you own,
sure.
What are your options there if you really wanted to diversify or you wanted to look at other options? Are you, in most cases, sort of tied into that platform, or can you move into other ones?
So the most common, I'd say, perception of that vesting period I have when I meet people is that vesting period is kind of the golden handcuffs. When that's up, I can sell it and just take the cash. And a lot of the time, when I meet someone who's in that position, they don't need cash. What they need is a bit more of a diverse portfolio, And although they might not be able to get that through the platform that they currently have, there are very simple planning exercises that we can perform just to, one, either move the stock into a more efficient environment or into an environment which they can be sold. You can sell 50% of them, or you can sell all of them and reinvest into something a bit more suitable for you as a client. And on top of that, you bring up a good point, because although they might not be able to sell it on that current platform, there's typically better platforms for them to be held on anyway from estate planning perspectives. From, like I said, diversification is a really good point, because for a lot of really high end employees, they're not only earning their salary from a company, they've also built up a big pension with a company, which they're, is more exposure to that one company doing well.
And then you've got stock on top of that as well.
You got your stock, and then obviously
maybe even insurances linked to the company,
health insurance. You've also got your monthly income coming from them. So if anything, you kind of got massive exposure to this one single company.
So if it all goes pop, you're in a lot of trouble.
Exactly. And I'm not saying, if you've got a massive holding of Microsoft stock that they're going to go pop overnight, but it's something I would certainly think of.
I think looking at stock history, no matter how stable a company appears,
sure,
no matter how consistent the long-term performance has been, it's always wise to diversify, irrespective of what that company looks like today. Because there's been so many cases in the past of where you've had a company that people thought could never fail, would always just continue to steadily rise, and they've just dropped. I mean, BlackBerry was a bit more of a flash in the pan. It came quickly and left.
Well, a good example
but you'd think the same about them.
Yeah, a good example in most recent history is Credit Suisse.
Yeah.
It's got Swiss in the name.
1886, I think it was. Was founded, and all of a sudden
no more.
Yeah, exactly. So that shows like a bedrock of the Swiss financial system can crumble.
Sure.
And why is anyone else safe?
Course,
and that's not to scaremonger.
No,
it's just a point on be cautious, always diversify, because anything can happen.
Of course, it's true.
So you did just touch upon estate planning and how that works. Now, for people who own stock, at what point is there a tax risk or is there a tax liability if their company's given them X amount?
So there's no kind of lower limit for certain jurisdictions. So I think one of the key things that people don't understand. So there is always going to be CGT. Obviously, the UK's just kind of moved the goalpost quite heavily as far as how much you can earn from capital gains before you get taxed and stuff like that. I think for a lot of people, that's becoming more apparent that the amount that they can make from their investments is becoming smaller and smaller and smaller before His Majesty takes his cut. And typically there are ways and means around that. Certainly for a British expat, a lot of the time British expats want to retire in the UK. So although that they might be in a jurisdiction now where they don't really have to worry about the HMRC or paying tax or capital gains tax, you need to make sure that you are planning for the future in the sense that it's not always going to be that way, and you can set yourself up now to build tax benefits from the future and then also not have to worry about it when you go home. So from a very UK-centric perspective, if you're holding a platform, that's great. If you're buying stocks and shares and you're buying ETFs or whatever it may be, and you're trying to build your wealth, brilliant. That's the first goal. The second is to make sure that you've bulletproofed them from an estate planning perspective. It's very easy to kind of forget that we're not going to be here forever. We're not immortal, unfortunately. Although people are trying to work on it, but
our CEO included.
Of course, yeah. I'm pretty sure he is though. So, but the point I'm trying to make is, although it might feel like a million miles away, there's nothing not to be quite morbid. And I always use this analogy with my family. Even is I could be hit by a bus tomorrow. So making sure that you've planned properly for the worst is always better than hoping for the best and the worst happening. So from a UK perspective or a UK investor perspective, and even clients across Europe, Far East, Australia, we've got an office in Mexico, the kind of one thing I was focusing on today or was thinking about today is that a lot of the clients that I meet as far as for the big US companies that have these employee share schemes don't realize that they would be liable to much higher rates of estate tax than if they were a US national. So for a US national, I think it's roughly, it's just shy of $1.2 million that you can leave to the family once you shuffle off this mortal coil and there's no estate tax liability. If you're a non-US national and there's no double taxation agreement between your nationality or nationality's country and the US, then your allowance is essentially, or your family's allowance, I should say, is $60,000. And then over that, the family will pay anything from 18% up to 40% in estate tax. And now, the reason I say that is because it's incredibly easy to mitigate. You don't need to sell the shares. All you need to do is sit down with a qualified, experienced financial advisor that can say, look, brilliant that you've built these shares up. Then look at the diversification. Are you diverse enough? Are you relying on them for your income, salary, your income, pension, you know, this wealth that you built up in shares, your healthcare, your life insurance, you know, is it worth having a look at what you can do with them, one, to get into a more efficient environment, and then secondly, you know, should you have that much exposure to the company that you also work for, you know? So as far as the US shares problem, I think that's the biggest problem that people are going to have, or I keep saying people, but their families are going to have, because at the end of the day, if I get hit by a bus tomorrow, I will not be worried, realistically. I won't, you know, but it's the problems I'm leaving for my family. You know, I've got 2 kids and a lovely wife, and at the end of the day, I feel like I should take as much care to make sure that the process of losing me is as painless as possible in the areas that it can be. You know, a very simple planning exercise, a case of sitting down, reviewing your finances properly, and you can remove so many issues for the family further down the road.
How long does this planning process generally take?
You know, it's not one size fits all, unfortunately. You know, you may sit down with one advisor and it may take an hour to review your finances and basically get a good understanding, or run through what we call a fact find, basically get an understanding of what you've got and where it is. You know, that's the one of the most essential parts of the process, is getting an understanding of you as a person, what you've got, where it is, who your family are, where are they. You know, that's what we need to understand first, and then on the back of that, you know, that's where the advice comes from. So
thank you so much, Ethan.
It's all right, you're more than welcome.